Everybody, Lance Browning of Income Solutions Wealth Management here in Tyler. We hope in spite of everything that you're having a good 2020 and that you're staying healthy. As always, we have our bull and our bear here with us, and notice this year they're wearing masks. Perfect symbol of 2020. We couldn't decide what would be the best representation or symbol of 2020. We couldn't decide between the N95 masks and toilet paper, so fortunately the masks won out. It's time again for our halftime report. So the theme this year is going to be COVID versus the Fed. Last year we talked about China versus the United States in the trade war that was going on. We discussed some potential threats to the economy and the markets going forward. One of the threats we always mention is called a black swan event. A black swan event is just something that comes out of nowhere seemingly, but is very disruptive to the markets and the economy. COVID-19 or the coronavirus has certainly been that. Just how disruptive has COVID-19 been? Well, take a look at the U.S. GDP growth. GDP, or gross domestic product, is the bottom line report card on the growth of the U.S. economy. You can see that we had been averaging 2.5% to 3% growth in the economy for about 3 years until the first quarter of 2020, where it dropped by a whopping 5%. That's when the COVID-19 shutdown took effect and the wheels really started falling off. We expect second quarter GDP to be significantly worse this year. This is how powerful a black swan event can be. Governments at all levels have found themselves in somewhat of a catch-22, no-win situation. Should we shut down the economy to prevent the spread of the virus? Or should we keep everything open and risk further infections? Neither option guarantees a good outcome. So we talked about how powerful a black swan event COVID was. You know what else is powerful? The Federal Reserve. One outcome we have seen is that both the federal government and the Federal Reserve have responded with unprecedented monetary stimulus. The total amount of monetary stimulus this year is about 22%. That's almost 1/4 of the entire U.S. economy based on GDP. That's huge. To give you perspective, during the entire 2008-2009 financial crisis, the total amount of stimulus was about 16.6% of GDP, or about 1/6 of the U.S. economy. As we've talked about in our audio blogs before, they're throwing everything but the kitchen sink at this problem. One of the things the market really fears is uncertainty. Here's a quote from Carl von Clausewitz. Quote, "Although our intellect always longs for clarity and certainty, our nature often finds uncertainty fascinating." End quote. We'll see how that plays out this year. Speaking of uncertainty, oh, by the way, it's an election year. This is one of my favorite political quotes, and it's from Senator Mike Enzi. With politics, if you're not at the table, you're on the menu. That brings to mind another famous political quote. I'm from the government, and I'm here to help. All that being said, the markets typically love presidential election years. Maybe it's all the hope, enthusiasm, or political campaign promises, but the data does bear this out. The average return for the S&P 500, or the stock market, during all election years is historically about 11.28%. You can see here the difference between the Republican and Democrats every election year, but keep in mind that data is skewed by 2008. So as we've talked about, it's this year, it's the Fed versus COVID, and we expect the Fed to win. In closing, here are our projections for the market for the rest of this year and next. We expect a 3,200 point S&P 500 stock market by the end of 2020. Now, given the declines in February and March, this would put our market right about even for this year, and I think we probably would take that, especially considering where we were in March. We project a year-end price target of 3,600 on the S&P by the end of 2021. That's roughly a 12.5% return next year. Let's talk about what can go right and what can go wrong with our projections. First, what can go right? Well, the economy can recover quickly after everything has been reopened. We're starting to see that. Corporate earnings or profits can show very positive quarter-over-quarter increases from the first and second quarter of 2020. I think we'll see that. Lastly, COVID-19 virus cases can be contained without a new spike in cases and or casualties. We're hoping for that one. Let's talk about what can go wrong. Well, the opposite could happen. Let's say the economy does not recover very quickly after being reopened because of job losses and the economic damage caused by the shutdown. This could affect corporate profits as consumers are very reluctant to spend money. We could see a spike in COVID-19 cases in the fall and in the winter, and unfortunately I think we are seeing that. And any uncertainty coming out of the election in November or the proverbial black swan event. Stay tuned. As always, we're here to help. Please don't hesitate to call if you have any questions. Once again, it's Lance Browning, Income Solutions Wealth Management in Tyler, Texas. Have a great rest of your 2020.